Welcome to the daily update, where I'll go over the action in the market for Friday, April 11th, and we'll see how things look for Monday, April 14th. One of the more wild weeks than what we've seen in quite a while. Does this mean we're near a bottom? We see a lot of jockeying around. Now, we're more used to the idea of a V bounce out of a bottom. That's what's happened over the last number of years. We're just kind of bouncing around. We ended up being up for the week, and we were up on Friday. There's still a lot of technical damage that's done, but very long-term support is still holding for right now with the S&P. But we're seeing some weakness coming into some other indexes. We have the NASDAQ, which is now generating a death cross. The mid caps and the small caps have already generated death crosses. We're not there with the S&P, but we're close. Is the same thing is true with the Dow. It's getting close. The NASDAQ 100 is also getting close. So the market's at a point where if they're going to salvage this bigger picture bull market or uptrend, then there's going to need to be some buying coming in. But all this craziness is being attributed to what's going on with the tariffs. Are they going to be a good thing, a bad thing? And you have a very emotional market right now where we just kind of blow through support and resistance, and everybody's just kind of running around, not really sure what's going to happen. We had a massive update on Wednesday, only to have a lot of that given back on Thursday, and then another update on Friday. So things are quite volatile right now. All right, let's go back and talk about what happened and then look at some charts. We did have a flat open. Now, the futures were kind of all over the place, and by the time we got set to open on Friday, they pretty much had gone nowhere from Thursday's close, and prices chopped sideways below 5,300 and then went between the unchanged level and the daily pivot at 52.45. That's 140, well, not quite 100. It's 65-point swing, which is a pretty good swing. We don't see things chopping around all that much. As the day went on, we were able to break above 5,300, which was more of a psychological resistance level. We got all the way up to R1 at 53.76, and then we were able to close at the intraday high. That's positive when you can pretty much close at the high. Now, we were up 1.81%, and now volume was above average, but really dropped off. So it was still healthy, but a lot less than what we saw, especially in Wednesday and Thursday's session. So we are still negative in the short and intermediate term. That's measured by are we above or below various moving averages. In the short term, that's the 20 period moving average. In the intermediate term, that's the 50 period moving average. We're mixed in the long term because we're below the 200-day moving average, but we still have a trend. We use the crossover system between a 50 and a 200 period moving average. And inflation for right now, folks are worried about that, but it seems to be under control. We had CPI and PPI come out, and I'll go through PPI here in just a minute. What's concerning are interest rates because they're really going up right now. We saw a 0.5% move up in interest rates in 1 week, and that's a big move. And people are trying to figure out why is that happening. And I have some, it's all speculation, just rumors. There's nothing really to substantiate this. I'll go through that here in just a moment. And a lot of it's just to do with these tariffs and what's that going to do to the economy? What's that going to do to earnings for stocks? And you've got folks that are pretty emotional right now. Okay, some comments. It was a crazy week that ended it on a positive note. And then here are a lot of the concerns that are going around. The dollar is really weak too. It's gone down under 100 with the US dollar index that I follow. There's other dollar indexes, but I use that one. It's kind of been around the longest, and I just got used to using that one. And yields, that's interest rates. They're going up. It's like, okay, they should be going down. They were going down before, now they're starting to go back up. We did get a consumer sentiment report that came out, and it's really, folks are not feeling really confident right now as a lot of these changes are taking place with the Trump administration. and they see 6.7% inflation in the next year. I mean, okay, that's pretty high. And then China, they're coming back in with the Trump China trade war that's going on, and they came in and said, okay, we're going to put 145% tariff on imports from China. That's what the US did. And then 125% tariff on imports from the US, which is not that big of a deal because we don't sell all that much stuff to China, but it's still going to impact US companies. And I'm not exactly sure what they mean by this. China said that they'll be ignoring any further tariff actions by the US. What does that mean? They can't control the tariffs that are put on the US. Are they just not going to play this game anymore? Does that mean they're getting ready to talk and President Xi and Trump are going to be able to sit down? Or is that just kind of a statement saying we don't respect you? We're just going to not really pay attention to anything that you're saying. That's a bad thing to do in this kind of an environment to take that attitude. So I'm not quite sure the context of all of that. And then banks, we're starting to come into earnings season now. And the big banks, they're the first ones to start reporting. Some of them were good, some of them are more, and had positive response to that. Some were probably pretty good, but had negative response to that on a case by case basis. But now, once the banks start earning, we're going to start to see other companies coming out with their earnings as well. And then the mega caps had a pretty good day on Friday. I'll go through the charts here and just later on in the video. And then the president is hoping to make a deal with China. We would call that the Trump put. A put option is what people buy to protect their portfolio. Because if you have, let's say, 100 shares of stock and you're worried about that going down, you might buy a put. And so if the shares that you have goes down in value, the put goes up in value, and you're basically hedged at that point. And I teach that in the program that I have, and that applies to indexes, individual stocks, and so forth. Well, the market is thinking, okay, Trump's going to come in and do something to that the market likes, and that's going to protect things from continuing to go down. But this has been on and off hope now for quite a while, and Trump has actually come out and said, I'm not really concerned about the stock market right now. We've got things we need to put in place, and the market's not going to necessarily understand what this is, but I'm still going to put these things in place, and then later on we'll come back and say, okay, now let's see if that can have a positive impact on the stock market. And there was also a report that came out that called the Fed put, that maybe they'll come in and do something if things become quite disorderly. Now, we're kind of there this week. We've got the dollar really going down, interest rates really going up, stocks flying around all over the place. And it's been not a real efficient market. That's why we're seeing these really big swings. And it's been healthy volume that's coming in, but we're not seeing things all that orderly right now. To have a big update on Wednesday, that was mainly due to short covering, which means that people that were betting on the market still going down and then the market started to go up, they have to buy back those positions, and that drives prices higher and higher. Um, and then Thursday, we had a fairly significant down day, but closed well off of the low. So, I mean, it's just sometimes we call this fast market conditions when things are really moving either to the upside or the downside. Then the VIX did come down, but we're still getting a very high reading. It's under 40 now, but we're still coming in at 37.56. We get nervous when it goes above 20, and it's still close to that 40 range. And we're seeing death crosses. Now, some of these have already been generated, like with the small caps and the mid caps. They've been weaker parts of the market in 2025. We're a couple of days into a death cross here with the NASDAQ, and we're getting close and generating one right now with the Wilshire 5000. A death cross is when the 50 period moving average drops below the 200 period moving average, signaling that we're going from an uptrend to a downtrend. And as I mentioned earlier on, the S&P is close, the NASDAQ 100 is close, the Dow is close, but those haven't actually been triggered yet. And that's going to switch the overall market more negative. Now, there could be some gyration. Sometimes a death cross is generated only to see the market pick up and move in the opposite direction and have that either negated or see the death cross go away. So it's not necessarily a real big change at that time. There's usually a real battle that goes on when these things are getting ready to happen, and we're in that battle right now. On a short-term basis, we're still looking extreme with our ADX. That's our trend condition indicator, and we still are getting a pretty high reading there. It means meaning that we've been in a strong trend, usually at the point where it starts to roll over and look like a weaker trend. And then the slope oscillator, that's a short-term momentum oscillator. It's extreme negative in our MACD. That's more short to intermediate term. That's another momentum oscillator that's giving a very extreme negative reading. And we already have one extreme positive reading, the rate of change going back over 5 days. We had an up week, and it was a pretty solid week. So you go back 5 trading days and base the close on Friday with 5 trading days ago, and yeah, it's already extreme positive there. But most of it's focusing on the extreme negative. We still have our TTM squeeze indicator that's extreme negative. The rate of change going back 50 periods, that's intermediate term. The PMO, which is a momentum oscillator, and then there's some studies that go along with that. We're still getting some extreme negative readings. The Copic curve is giving an extreme negative reading. That's another momentum oscillator. And we're still far away from the 50 period moving average. We're below it. And that's the boom indicator. We get too far away, then boom, we have a tendency to go back to the moving average. And then in the long term, we're looking extreme with our 150 and 200 period simple moving average study, meaning that that's become a little too extreme negative as well. No real changes to the scenario. We did get the Fed meeting minutes this past week, but they didn't really tell us anything that the market didn't know, that they're worried about inflation going up and employment going down. And at least with CPI and PPI coming out and the employment data that we received on Thursday, that doesn't seem to be a problem yet, but that could start to turn into a problem going forward. The dollar was down and down big. It dropped under 100 with the US dollar index, and this is where interest rates were up. We're at almost 4.5% here. And that's where stocks really started to freak out is when we get above that 4.5% level. But a week ago, Friday, we were at 3.99%. So there was a big jump on Friday that didn't seem to have a real negative impact on stocks, but interest rates are really going up here. And sentiment is still extreme negative. We can't even seem to get back up to 25. We're coming in at 13, where after Thursday we were at 8. And then our trend is negative, and it's still a strengthening trend, meaning that it's above the moving average. We're not quite at the point where it's starting to get weak yet. And with the up day, the bias is positive, and I'm still keeping the momentum at negative for right now, even though it was an up week. We've been just jumping up and down all over the place as far as price. Okay, so we did get PPI that came out. CPI is the big one, that's Consumer Price Index. The PPI is the Producer Price Index, and they expected it to be up 0.1%. It actually fell 0.4%. That's market friendly there. Last time we had the report, it was up 0.1%. And then the inflation component is the core PPI. You take out food and energy, of course, the things you have to have. We're not going to include that in the report because they think it's too volatile. It was down 0.1% on a month over month basis. They expected it to be up 0.3%. So that was taken as market friendly. Or last time it was up 0.1%. You calculate that out to a year over year basis, it's 2.7%, where the last time we had this report, it was a year over year 3.2% growth there. If you take out food and energy, it's up 3.3%, down from the 3.5% from the reading in the previous report. Consumer sentiment, this is discouraging to a lot of folks, and this has been the catalyst the last few times to really send the market lower. Well, it dropped again and the market went up. So it came in at 50.8, and that's weaker than the 54.8 that they had expected. Last time we had the reading, it came in at 57. And you have to look at this on a year over year basis. A year ago, we were at 77.2. And basically, it's the people are feeling it's just uneasy. They don't really understand what's going on. Whether you like it or don't like it, it's kind of complicated. And people just, they take one word, tariffs, and then put all of their meaning behind that word without really understanding all of the things that can go on under the surface with that. And also, as far as how people are feeling, they expect unemployment to rise, but it hasn't yet, but it really could. And that's what we're watching to see, are we going to go into a recession? Because for right now, the employment situation has been holding up quite well, and they expect inflation to go up. And this is a terrible mix that really brings out the concerns about future consumer spending strength. Okay, now this is one of the things, and this is pure speculation because we really don't know about these things until after they happen. I explained this in Friday's video, and I have another little rumor type of thing. And it's not a conspiracy. It's just when things start acting weird, especially in the bond market, we try to figure out why. And you only know this about this for sure after the fact. It's more harder to read in the real time. But if you look at the different countries that own U.S. bonds, Japan owns about $1 trillion of U.S. bonds. China is in second place with about 760 billion. And then there's other countries too, the UK, and there's a company or countries that come and go off of this list. There is speculation because China has come out and said, well, we're just going to ignore whatever tariff things the US is doing. Well, it doesn't mean they're not doing anything. They could be going in there and taking part of the 760 billion and actually selling those treasury bonds. When you sell bonds, that pushes prices down and interest rates up. And so there's speculation that something like that may be happening. And then another rumor that's floating around is that there was a Japanese hedge fund that is on the wrong side of things that are happening right now, and they're having to sell a whole lot of bonds. And that could be pushing prices down and interest rates up as well, because in Japan, as a country, they own over $1 trillion of U.S. bonds, and if they're dumping these things, that's a lot of volume, and that can really have an impact. But it's speculation. There could be more to the story, but we try to figure this out as close to when it's really happening as we can, and so that means that you just kind of have to guess about what's going on. Okay, here are the charts for PPI on a year-over-year basis. It shows it declining with the blue line, which is the total reading, and going down here with the core. That's the inflation component, and the market likes that. And then final demand year over year going down with goods and services. Okay. And then intermediate term goods, processed and unprocessed, coming down with the yellow line here. That's unprocessed goods, and just kind of going flat along the zero line with the processed goods. This is the chart that I use to look at a year over year change, the 12-month rate of change, where it's starting to come down. Now we want to watch this because if this continues to fall, that's bad. There's periods of time when good news is good news and bad news is good news, but you get to the point where good news is too much of it and it turns into bad news, or good news turns into bad news. It can switch around here. But for right now, the market seems to like that. And then we look at the month over month change, and that's actually dropping negative. Then here's the core part. This is the inflation component here. We're pretty much level on a year-over-year basis, where we are seeing a decline on a month-over-month basis. Then this is how people are feeling. You can see all three of these lines are going down. And this is consumer sentiment. The blue line, which is kind of in the middle right here, that's the total reading, and I have a chart of that to show. And then expectations, looking out into the future, that's the yellow line, and then the purple line is how people are feeling right now. And all three are going down as there's a lot of uncertainty. This is the chart that I show. The blue line, that's consumer sentiment, where we're seeing this really dropping off. And to give it some context, I also put the 2-year Treasury yield on here, and both have been coming down lately. So we just keep an eye on this to see how people are feeling about things. Then Isabel Net blog charts here. This comes out from Real Investment Advice. This is the PE ratio And then what are they looking at for earnings here? And what would the PE ratio be? So we have $253 per share for the S&P. And then we have this 10, 15, 20 scale to see if the stocks are considered to be expensive, fairly priced, or inexpensive. Well, if we have earnings coming in at 253, that's for the whole S&P 500. And to get an 18 PE ratio, that would put us right around this level, which still would be more of a decline from where we're at right now. Now, to get down to being more fairly priced, that of course would take us down to about the 4,000 level. And if you watch the intermarket analysis video that I do, that's about where we need to go just to get back to being fairly priced or even not expensive anymore. A PE ratio of 20, that's when we start to get expensive. And that would put us right a little bit above the 5,000 level. And then to get expensive would be at a 22 PE ratio there. And that would get us up into the above the 5,500 level. Okay. Then feel free to pause this and look this over if you want to. It says big gains tend to lead to much higher prices. Okay. When we have a lot of times when we see a big update, it's after we've really been going down. And that was, they're talking about Wednesday, the big update. Well, then we ended up having a down day on Thursday, and then we bounced back on Friday. And what does it look like after we have those kinds of days? Usually, the next day, that's very common. We have a downward move, which is what we saw. 5 days later, things don't seem to look much better. But when you start looking out 1 month, 3 months, 6 months, 12 months, that's when things start to improve. And you have a lot of folks thinking that, okay, long-term support is holding for right now, and I'll show you what I mean by that. Maybe we've hit a bottom here, but there's still a lot of technical damage that is being done to the market. So we don't necessarily have any proof that things are switching back more positive. In fact, they're still having a tendency to look more negative. And then here, despite median intra-year drops of 15%, the annual returns were positive in 34 out of the last 45 years. This just shows even if we had a good year, what was the drawdown or the negative, the decline that took place in that year. And then duration of bear market rallies. This was in June of 2022. This is when inflation, for right now anyway, topped out and the Fed said, yeah, we're going to start cutting back on our balance sheet. And they've been doing that ever since here. But this just shows how long some of these bear market rallies can happen because we were already in a bear market at that point, and then we bounced up, and then we hit some overhead resistance and then started to come down. But that lasted for a period of time. Okay, I'm hitting the wrong button here. And then the S&P gets hit after the biggest rally. So this was Thursday's action, just to show we had that big move up on Wednesday and then the downward move on Thursday. This doesn't include Friday. Consensus forward PE ratio against earnings per share growth that's expected. Just showing where the S&P is at. The NASDAQ 100 small caps look quite a bit lower over here. And then they try to draw a little bit of a line to get some kind of a trend or to connect these with each other. But they're still expecting the strongest earnings to come in, at least forward PE growth here with the NASDAQ 100, and then the S&P is not far behind because the stocks in the NASDAQ 100 are also in the S&P 500, where the NASDAQ 100 is all growth. There's growth and value in the S&P 500. Then the daily range, this is big. These are the big swings that we've been seeing. Big up days and percentage moves that are much larger than we've typically been seeing here. Then this is an interesting chart. This is tech trailing returns. This is focusing on tech. And you can see on the chart here with the NASDAQ 100, we're really coming down to this 3 standard deviations. That means that we're oversold at this point here. And sometimes when we've come down to these readings, that can mark a bottom. And then we see a bounce up off of that. And we're at that point right now. And we'll have to see if something like that ends up happening. And then this is looking at the tech sector for the S&P 500. We're also getting real extreme negative readings below this 3 standard deviations level right here. All right, so here's the chart. I mean, if you look at Friday, even though it was a big day compared to all the other craziness that went on, it actually looks kind of tame where we had pretty much a flat open, and then we were having difficulty getting through the 5300 level, fell back down below the daily pivot and just chopped between the unchanged level and the daily pivot. Then finally later in the day, that's when we started actually be able to break above the 5300 level, made our way all the way up to R1, and then you can see there's not a lot of conviction going into the close. People wanted this week to be over. And so you probably had a lot of folks take it off, but we were able to close pretty much at the high right there. And then things didn't change all that much as they shut down. They continued to trade for a while on Friday, and then they closed for the weekend. And we'll be watching things when they open Sunday evening. Not seeing much of a change here other than an improvement with growth and value on an intraday basis, but we're not really seeing the blue line or the red line really leading each other. They're more going hand in hand right now. And this is what we want to see if we're more positive. We want this intraday growth to value ratio to go up. Well, we had been, but then we started chopping sideways here. Doesn't mean we've turned negative. It just means that we might have slowed down. We want to see more follow through if this goes up. If this starts coming back down again, that's going to be more negative. So end of day, growth was up more than value for the large caps, mid caps, and the small caps. So that helped things there. So our small cap growth to value ratio is showing some improvement. Not much of an improvement here with mid cap growth to value. And we're getting near a death cross here with the S&P growth to value ratio. We've spent, well, pretty much since March now, the early part of March, we've been below the 200-day moving average. And so this is chopping around, but we're getting ready to see this ratio cross over negative. And that's a ratio. That's not an index, but still we can get some insight from this that growth is starting to underperform value longer term. And here's another growth to value ratio where we're still below the rainbow. It showed some improvement this week, but just really choppy right now. Discretionary to staples, it actually went down with their ratio and also below the 200-day moving average. And here's the condition of the intermediate term trend, which is what I focus on the most. We are rolling over, meaning that the trend could be starting to weaken, but we haven't crossed below the moving average yet. Now we went above 40 here with the red line. That's an extreme reading, and you can see that's when we had the big down day there, and that's been dropping off. But we're still negative because the red line is above the green line. Now, in the short term, we're still above 40 with the ADX itself. That's why it's extreme positive. That often marks in the short term, okay, this trend is getting extreme and it could be starting to weaken, but it's still negative because the red line, although it's coming down, is still above the green line. Volume still above average, but dropped off. You can see that here, just barely above average in Friday's session. And we're still 12.71% on a closing basis. We're below that from the February 19th all-time high. That's way up here. And it's if we close 20% or more off of that high, that's when we go into a bear market. That's the definition of a bear market. We got really close, and even on an intraday basis, we went into that 20% area, but we've been able to stay above that for the time being. And we're wondering, are we going to be able to bounce up out of this and clear this correction area that we're in right now, or are we going to come back down and actually go deeper into an actual bear market? All right, sentiment still showing a lot of fear here with the Ulcer Index. Even though it's coming down, we're still in the high 30s now with the VIX, but as stocks go up, the VIX goes down and vice versa. And the VIX of the VIX also very volatile over the past week or so. The momentum for the VIX continues to be up as measured by the MACD, and we're seeing real choppiness here with this fear gauge, but really elevated. This also is another elevated fear gauge here, but it's been chopping around lately. So we're seeing across the board confirmation of fear, which is not really all that surprising. We really dropped off with the daily chart on the equity put call ratio, enough to where we're going down with the 5-day chart and the 10-day chart. Not sure we're getting an awful lot of use or real good insight from these charts lately. There's periods of time when the equity put call ratio seem to be really helpful, and other times it's like, okay, not really sure this is helping us all that much. And getting a very low reading here with the volatility risk premium. This could be positive. And when this goes up, that means there's perceived fear going forward up for the next 30 days in the market. Well, we're getting a very low reading with that right now. And we're still looking positive with the advanced decline line based on price. We're above the moving average, but even after improving, we're below the moving average here. So we're getting a bit of a mixed picture based on price and volume. Now, price is the ultimate indicator, so we have to follow that, but we keep an eye on volume just because that shows us the intensity of different moves. Seeing a bit of an improvement here with our advancers decliners over the last 10 days. We came down right to this minus 100 level, and we've been able to bounce up off of that. This green line is when it's considered to be extreme negative. Even though it could have gone deeper than that, it actually stuck or changed right at that level. We're also seeing more continued weakness here internally in the S&P. The new lows, even though there's less and they've been contracting, they're still very high. And that's causing our 5-day chart and our 10-day chart to really go down. And looking at these, you could say maybe we're hitting some kind of an extreme negative reading with these two indicators here. And we're positive with the accumulation distribution. We're above the red line. That's when we call this positive, and it's going up. And the advanced decline ratio did improve, but still below zero. Short and intermediate term, 19 and 39 periods, that's improving, but still negative. And we break this out, including volume in here, and both based on price and volume, we're still below zero with the advanced decline ratio. And we're positive with the Chaikin money flow. The histogram is improving, the red line's going up, and we're also positive with the Chaikin oscillator. We're crossing above the midpoint and above this moving average. We're negative though with the vortex. The red line is above the green line, and we're trying to improve here. We're just on the border of being extreme negative with those stocks in the S&P above their 20-period moving averages. Right on the border too with those stocks above their 50-period moving average after being extreme negative. So there is some improvement here. And I'll wait till I get a chart. I want to show you that maybe I can point this out here. This is a pretty good looking chart pattern that we see where we're seeing a series of higher highs, kinda, and a series of higher lows. And so you take this and it could be looking like the market is trying to bottom here, but we don't really have any confirmation of that with our other indicators. And we're showing some improvement here with those stocks above their 100-day moving average, and we're still extreme negative, but improving with those stocks in the S&P above their 200-day moving average. Still showing more weakness overall here. We're below the moving average with the NYSE common stock, S&P mid caps, and small caps. And this is another broad market measure of a 5-period moving average of the highs and lows, getting really extreme below this red line, which quite often is an extreme negative reading. And then this is what I'm talking about with the potential death cross. Well, it's going to be a death cross. We just aren't quite sure when it's going to trigger. The blue line, which is a 50-period moving average, is coming down and getting ready to cross below the red line. We haven't seen that happen since it crossed over positive back in early 2023, and that's the uptrend that we've been dealing with ever since. Is that in jeopardy? And as long as we stay below both of these lines, this death cross will happen. It just hasn't quite become official yet. On the bottom, we were above average with volume. You can see it really dropped off from Wednesday and Thursday's massive volume there. We're no longer extreme, showing a little bit of improvement with the 20-period moving average, 50 right on the border, and a little bit of an improvement with the 200-period moving average on the S&P. This is where we're getting extreme here with the Stochk RSI. It had been extreme negative. These are very touchy indicators, and with the upward moves that we've seen, it's already getting extreme positive. The Williams percent are improving, but not extreme yet, but it is above its midpoint. The CCI 14, after being extreme negative, is now showing an improvement, as is the CCI 20. And not really showing anything extreme with the stochastics. We're just, you see all the choppiness here. We're right around the midpoint with the short term stochastic, crossing above the midpoint with the intermediate short-term stochastic. After being extreme negative, we are turning back up with the long short-term stochastic because that's a further subdivision of the short-term time frame. We had become way extreme negative with the force index. Now we're back to positive. The condition of the short-term trend, you see a lot of choppiness with these lines. It's not quite sure what's happening. There's really no conviction right now, but maybe this is showing some improvement overall after it had been really declining. This is the rate of change going back 5 periods where we had been extreme negative. Now we're getting to extreme positive. That just shows all the craziness that has gone on lately. And we're in the -1 channel with our standard deviations chart. That's because of all the craziness we've seen there. And this is another way of looking at inflation. It's called trueflation. And as of Thursday, that's the last time this was updated, inflation is coming in at 1.35%. That's below the 2% level that the Fed wants. But it's not like the Fed looks at this. Okay. And then in November, it was at 2.5%. So it has actually been coming down according to this. But this is a site that posts this information. It's relatively new. It's not like the Fed looks at this. Okay. So, but we just want to see, is this something that gives us some deeper insight? All right. Intermediate term, just kind of chopping around the middle here with the balance of power. And even with the update, it declined. And we're below the 200-day moving average. Right now, it's 6.79% below the 200-day moving average. Still of the lighter shade of purple here with the go, no go. So it's improving, but still negative. And the lowest low value, after we've really been declining, we are improving here, but also still below the midpoint. This is the condition of the intermediate term trend based on 50 periods. The lines are still going down. So we're still negative with the intermediate term trend. And these are anchored moving averages going forward, where we're just kind of blowing through these support and resistance levels here. We're not really stopping at any of them for any given length of time. And we're below all the simple and exponential moving averages that are plotted here. And that's why this continues to roll over. And we're not far away from the 20 period moving average right now. Well, I take that back. We are. When we get down to -100 here, we're still pretty far away right there. We are far away from the 50 period moving average. And then price has a tendency to revert back to the moving average. No, I guess we're not here. Okay, this one's a little harder to read. These red arrows I have are the extreme reading areas. So the TTM squeeze improving, turning lighter shade of red, but still below this black line. So it's extreme negative. To give it a little bit more context, I go longer term with this going back into 2022. So it's still extreme negative there. The rate of change going back 50 periods, we're still below this pink line. That means we're extreme negative there as well. Standard deviation, yeah, we've been jockeying around all over the place. So standard deviation measures speed over the last 10 periods, not direction. It's still quite high. The ease of movement is improving, but still below zero, so that's negative. The Arun is coming off of being an extreme negative reading. That measures the sellers versus the buyers. And the sellers were in complete control. That's why we were getting a negative reading. This improving shows that buyers are coming back in. Excuse me there. Gotta love these take one videos. Still below zero here with the S&P McClellan oscillator, even though it's improving. When that's below zero, we're declining with the summation index based on price, and we continue to decline based on volume. So that's still negative there. A broader market measure with the NYSE McClellan oscillator also still below zero. We're declining with the NYSE summation index based on price and volume. We're actually turning positive here with the Swanland trading oscillator. Turning up, but still below zero based on price and volume. Extreme negative with the momentum. This is the price momentum oscillator. This was developed by Carl Swinland, and it's become his main momentum oscillator. And then what he's done is he takes all the stocks in the S&P and says, okay, what's happening with all 503 stocks in the S&P itself? And that's the next page that I show here. But when we look at the PMO, we're getting an extreme negative reading. We're still declining based on price and volume. This is the studies. The percent of PMOs that are rising inside the S&P, no longer extreme negative. We are extreme negative with the PMOs that are generating buy signals in the S&P, but it's improving. And we're pretty much flat and still slightly declining with the PMOs inside the S&P that are above zero. And we're neutral with the Elder's Impulse system for the S&P. Negative since the dots are on top with the parabolic SAR for the S&P. Extreme negative and still declining with our short-term momentum oscillator, the slope oscillator. This is the MACD. It's improving, but still extreme. You can see it's very low readings, much lower than what we had been getting before. And we're showing an improvement here with our other short-term oscillator, the TSI. It's actually coming up and turning more positive above its moving average, where the other short-term oscillator, the slope oscillator that I just showed, that continues to be negative. We are improving in the intermediate term, but still below the moving averages. We're still negative with our longer-term oscillators. And this is another momentum oscillator. The Copic curve, still negative there. This is a longer term chart suggesting that we could be getting extreme negative with this. And we're still just right on the border between not and being extreme negative with the Sean trend meter. We're still negative with the money flow. It improved, but it's still below 50. Still below 50 with the ultimate oscillator. Still below the moving average with on-balance volume. Now this has actually turned positive. We've seen enough of a bounce here with the S&P bullish percent index to cross back above the moving average after getting really extreme negative here. So this is actually looking better. And we're actually seeing an improvement here with the NYSE bullish percent index after getting really extreme negative. And also, we had already been extreme negative with the NASDAQ 100 bullish percent index. That's improving as well, but it's still extreme negative. And we're still below 50 with the intermediate term RSI based on 14 periods, as well as the short term based on 9 periods. And we're still working off of a mass index signal, thinking that there should be a reversal. And now the mass index is in the process of generating another signal. So this is something I don't put a lot of reliance in this. The idea is that whatever's happening that generates this signal, it'll be the opposite that happens, meaning a reversal. But I don't use it all by itself. I use it with other charts to see if there's some kind of a confirmation. And now this is pretty good for the time being here. This goes back a year ago with the Fibonacci retracement level. So this is shorter term from the April 2024 lows to the February 2025 highs. We're coming back up here and improving, but we're still below this 38.2% retracement level. This is actually a little more positive and it's longer term, going back to the October 2022 low to the February 2025 high. This is important. This 50% retracement level has held to this point. We came right down here and we've been able to bounce up off of that, and we've been able to regain the 38.2% retracement level. And we're still above the midpoint with our trend channel going back to 2009. So that's longer term support that's holding for right now. And this was quite negative, but is holding for the time being. This is a weekly chart of the S&P, and we fell down below this S1 level, and we were able to come back and close above this S1 level. That's the positive side. The negative side is that we lost this pivot point here. That had been holding as support, and we broke down below it. It'll be more positive if we can go back up and close above that, but it may act as overhead resistance if we try to bounce back up from here. And this is a long-term trend line going all the way back to the 1987 crash. We're right back up to this trend line after we had been below that. And then this is also a longer term trend line, October 2022, October 2023. I try to connect those two lows and then just extend this trend line forward. So far, we're holding up above this trend line. Now, this is more negative because this is a ratio from the SPY, which is the ETF for the S&P, and staples, which toilet paper, toothpaste, the things that people have to have no matter what's going on with the economy. And those are the types of stocks that people get into when the market's getting ready to go down. And we look at a ratio between that, and we can see at the end of 2021, this started to show weakness We hit the all-time high with the S&P in early 2022. So this gave us an early warning sign. Now, looking over to what's been happening now, we set a high in January with this ratio. We set the all-time high with the S&P in February. So is this the early warning? We're watching this and we're thinking maybe it could be, but if things start to improve, it could negate a lot of this negativity that we're seeing here. This ratio going down just means the market's getting more defensive. All right, so we're looking a little bit better here with the Heiken Ashi. We have the open candles, but we're still negative. However, we're pointing up with the Kegi chart. When it's red, that's negative, but pointing up is slightly positive. And the Renko chart is negative with the red blocks, and we're positive now with the three-line break. So you've got our charts that are confused right now. And this is crazy. There's no real signal with the point and figure chart right now. This is all the craziness that happened here. And since we had an update on Friday, we're seeing green X's coming into the mixed into the picture. Long term, we're still below this green line. I just use this as kind of a guideline here with our 150, and we're just a little bit below it here with our 200-day moving average. That just means we're going down pretty far, pretty fast. And a lot of times that marks an extreme bottom with this longer term indicator. And we're still negative in the short and intermediate term across all the stock indexes, where we're negative with the mid caps and the small caps. And bonds have switched to negative in the short term and long term. Commodities are negative in the short and intermediate term. The dollar is now negative across the board. And you would think with all these tariffs, that usually is positive for the dollar. And we're seeing the dollar going down and interest rates going up. You'd think it would be the opposite of that. And that's what's causing a lot of the unsettledness in the market currently. And then on Friday, all of the sectors ended up being positive. We had communication, it was up, but up the least. But at least that's a growth area. And then we had tech, that was one of the stronger areas as well. And we want those to do good. And communication was up, but up the least. But all the sectors ended up being positive. And these are the alerts. We had gold. A lot of people are getting into gold, and that when things are really uncertain, that's when we tend to see gold rising. But mostly green signals here with the NASDAQ crossing above different levels, the Dow getting back above 40,000. Communication, this is positive. It had been below 20 with its bullish percent index. It's now crossing back above that, and that can be taken as positive. And this is the BPI cross above 20 that I was showing there. So there is some improvement, but there's a lot of damage that still needs to be repaired for us to turn more positive, which means that we could easily switch back and look more negative. Here's the Dow, well below its 200-day moving average, came up to this S1 pivot point here, and that was the overhead resistance for Friday. Watching the trend lines here, they're not there yet, but they're getting close. We're neutral with the Elders Impulse system for the diamonds. We are now seeing a death cross with the NASDAQ. The 50 period is crossing below the 200. And we're close in probably another day or two, unless we have like a 20% gain in one day. We are probably going to have a death cross here with the NASDAQ 100. And we're neutral with the QQQs when looking at the Elders Impulse system. Momentum for the NASDAQ 100 is improving, but still negative. And we've already had a death cross here with the S&P 600, which is one of the small cap indexes that we follow. And then the other small cap index is the Russell 2000. That's also generating a death cross. Neutral with the Elders Impulse system for the small caps. Also a death cross recently right at the end of March with the mid caps. And neutral with the Elders Impulse system. This is another death cross that we're starting to see. A broad market measure, the Wilshire 5000. That is starting to turn more negative. And we're not quite there yet with the total U.S. stock ETF, but we're getting very close with a death cross there. Financial sector, it's still in a more solid uptrend. The blue line's further away from the red line. And we had an update on Friday, but it still has not been able to get back above its 200-day moving average. The FANG index, these are the really big stocks, also showing weakness, but improving over the last few sessions. Then Apple was up over 4%, but it's in a downtrend right now. Amazon below its 200-day moving average in a weakening uptrend. Microsoft's in a downtrend, coming back up and can't seem to get back above its 50-day moving average. Google is now in a downtrend, and Meta is in an uptrend, a little stronger, but still below its 200-day moving average. Nvidia is in a downtrend as well. And Tesla, we could be getting ready to see a death cross here as well. Netflix, again, stronger trend. The blue line's further away from the red line, and but it's still below its 50-day moving average. It was actually down a little bit on Friday. We're seeing more of a strengthening correlation between US and world stocks on a short-term basis, and it's also getting stronger on a longer-term basis. Oil continues to drop. It's still in the low 60s, even though it bounced on Friday. This is the dollar. This line that I have here, that's the 100 level, and we're actually falling below that. This is what we're watching for bonds because we had been coming down nicely. That was seen more as a flight to safety. Well, if the market's still all freaked out, then interest rates should still be continuing to drop off. No, they turn and they're starting to go up. Is that some hedge fund, whether it's Japan or another country, that's having to sell a lot of their bonds because they're seeing pretty hefty losses? And that pushes interest rates back up. Is that China selling some of their bonds to push interest rates back up? That's pure speculation at this point, but it's something that could be happening and really explaining why we're seeing this real surge in interest rates over the last week. And we're declining with the 10-year based on price. We are seeing some improvements here with our growth to value ratios. We're getting back above the moving average with the Qs to S&P. We're going sideways, but we're not really falling apart with discretionary to S&P, and we're getting above the moving average when we compare large cap growth to value. So a bit of an improvement with the large caps, mid caps, and really seeing a nice improvement here with the small caps. So what's our outlook for Monday? And I haven't changed this because overall the overall scenario has not changed. We're still negative in the short and intermediate term, and we're mixed in the long term. We're not going to have any economic reports on Monday. And then what's going to be the news? What's going to hit the market? What Trump's going to announce that China's probably going to ignore? Or what's going to be happening there? And there's just a real intense battle going on. That's why we call it a trade war, as these things try to get figured out. This is what the economic calendar looks like in the upcoming week. No reports on Monday. The market will be closed on Friday for Good Friday, but we will get retail sales on Wednesday, and then we're keeping an eye on jobless claims and continuing claims as well. This is also another look at the economic calendar. Seasonality, we just seem to be just kind of, bleh, who cares about seasonality? But for April 14th, we're positive with the Dow and S&P, where we're neutral to negative with the NASDAQ. We are coming into options expiration week, which in April tends to be up 67% of the time and down 33% of the time. So that is historically positive. This is what we look like for the 14th here. We do get a little bit of positive seasonality if the market even chooses to follow any kind of seasonal pattern. So we're still negative with the S&P and NYSE McClellan oscillators and summation indexes. And the reason why this is gold is I consider those to be primary indicators. And the parabolic SAR is negative. The momentum is still negative for the S&P. The bullish percent indexes are improving, but they're still negative. And our moving average studies improving, but still negative. Ease of movement, money flow, and the ultimate oscillator they're white because I call those secondary indicators. Where the vortex is a primary indicator, it's also negative. The long-term special K, which I'll show in the deep dive video over the weekend, that is still negative. And the momentum for the NASDAQ 100 is improving, but still negative. Then on the positive side, we have our three smart money indicators, which are still looking okay for the time being. And we're just about ready to change this. The long-term growth to value ratio, we're getting ready to see a death cross there, looking a little more positive, but still weakness with the discretionary to staples. So it's positive longer term, but short term, it's clearly negative since these ratios have been hanging out below their 200-day moving averages. The Swindle Trading Oscillator, that's a new addition to the list here, and that's positive now. The financial sector, but it's below its 200-day simple moving average. And then we're seeing that mass index reversal signal. The signal was generated that we're seeing now when we were coming down. That's why I have this on the positive side here. Okay, our conclusion, we're negative in the short and intermediate term, and we're mixed in the long term. I should have taken this out. This was Thursday. There was some follow through in the Friday session, but we really did see a drop off in volume. And so in the short term, we're negative, and we have some extreme negative readings, but there are some improvements, and we're seeing some of those improvements after being negative in the intermediate term, and we continue to be mixed in the long term because we're below the 200-day moving average. Thank you. I hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.